Too many people associate retirement with the end.
I figure it'll be a little bit of a transition to try to slow down a little bit.
The number one question I have about retirement is having enough money to last.
In my mind, you start to look at it, that's an opportunity to do more of the things you want when you want to do it.
Make it financially able to do things that I enjoy.
Party.
Just financial security and enjoy my family.
More people need to go into it with their eyes wide open, understanding what is my plan, what do I want to do, and then how am I going to get there?
Will the rules change?
I have no real specific plan.
I'm planning for what the status is right now. I just hope it doesn't change drastically.
Welcome to the Retire-tastic Show with Joanne Regan, powered by the Retirement Income Store and brought to you by Financial Security Group of Arizona. In retirement, it's all about income. And today, you'll hear ideas, concepts, and strategies designed specifically to generate reliable retirement income. Now, here's the host of the Retire-tastic Show, Joanne Regan.
A friend of mine recently asked me, do your clients really appreciate how important it is to plan for financial resilience? My response to them was absolutely. I love planning. I think planning is the name of the game. A lot of people fail to plan, and unfortunately, they could possibly be planning to fail unless they have too much money to deal with. Sometimes even then, they'll go through unnecessary losses that they otherwise possibly could have avoided. We intentionally, at my office, meet with our clients within 3 months after they become a client. Well, why? Because most clients, when they hear the message about income, they take the blind, faith-like decision and move forward, hoping what they're doing is the right thing to do with their money. And that's how we make our decisions, right? We have that gut instinct and we follow that gut. So during the first 3-month meeting, they start seeing their own money working for income. What a novel idea, right? When I say invest it for income, it's a return on your money. However, the difference is you can spend it or you can reinvest it. It's like that aha moment. It's like finally there's a better plan B. So welcome to the Retire-tastic Show, and I'm Joanne Regan, your host. Buckle up. We're excited. This show is sponsored by Financial Security Group, also a franchisee of the Retirement Income Store. So when I say you're invested for income, it's like a return on your money. However, the difference is you can spend it or you can reinvest it. And like I said, it's that aha moment. And a lot of times when retirees hear the word income, they think of many different ways of receiving their retirement income. They can take withdrawals from a portfolio, or what I call engineering their income by taking withdrawals based on the growth potential of their portfolio. The problem is growth comes and goes. So when I say income the old-fashioned way, I'm actually talking about receiving dividends and interest on your money and the stuff that goes directly into your bank account. So you can spend it on your bills, your travel, the ice cream store for your kids, whatever you'd like. So if you're looking for an advisor to help you get through the next 20 to 30 years of retirement, there's really a lot that you need to consider. When you're hiring an advisor, you're interviewing them. You want to know if they're a fiduciary. This is the most common desired planner today because they are acting in your best interest. Before you set up that meeting or put the cart before the horse, you really want to make sure that you do your homework. Go to Broker Check and type in the advisor's name with their address. And if it says investment advisor with their name, then they're a fiduciary. There's a certain license that you have to obtain to be a fiduciary. Also, a real fiduciary will put in writing what they plan to do for you. Sign it and be held to it. If they won't, then they're not a fiduciary. Unfortunately, there are far too many financial types out there masquerading as fiduciaries. Remember, if they will not put it in writing and sign it, they're not a fiduciary. Simply say no, thank you, get up, and walk out the door. So let's talk about investing for income. Not just any Tom, Dick, or Harry can do this. They may say they can, but just like the guys masquerading as fiduciaries, there are just as many guys masquerading as income specialists. The trick here is to find an advisor that can actually invest for real income the old-fashioned way. I've put together a companion piece that goes with this radio show, and it's a commission report called The Universe of Non-Stock Market Alternatives. Again, The Universe of Non-Stock Market Alternatives. And I'd like to get a copy of that into your hands just for listening today. So why don't you give me a call at 1-800-FSG-7890, and I'll email that right out to you. When you retire, you want your money to last longer than you do. And investing for income is the only way I know to get you through retirement. Unless you want to use one of those spend down schemes for income type of strategies that are out there today, what some will call the bucket philosophy or strategy, you need to talk to me and let me show you how you can do this. You work too long and too hard to just spend down your money and run out before you run out of life. You deserve better. Buckets are for washing your car, not for retirement planning. You see, there are simply too many things that can happen in life that people can't actually plan for. And that's why I called this show Dealing with the Unknowns. So what are the unknowns? Well, here's just a couple. We don't know what the market is going to do tomorrow. We don't know what inflation is going to do. The only thing we know is that everything seems to be increasing, and that means our investments have continued to grow at a minimum pace of inflation, and that could be 3 to 5% a year. And this is why I really like investing for income, because our clients are getting a minimum of 3 to 5% out of the gate. What's left is going to depend on the market itself and the performance of that particular stock, bond, or bond-like instrument. We all know that inflation depends on what happens each and every year with the price of goods going up. The price of gas is up from a year ago, and with that in mind, all the truck drivers on the road carrying the goods, they then have to charge more. Prices of goods at the grocery store have gone up, restaurant prices have gone up, and they have a lack of help, so they have to increase the price in order to keep their doors open. As the value of stuff goes up, so do your money needs. You need to combat inflation, and the only way you can do it is to have a strategy. You have to have a strategy, especially when you're in retirement, that pays income at a minimum. Because if you're getting 3 to 5% in dividends each year net to you, then you have a high probability that you're already keeping up with inflation. So when it comes to hiring an advisor who's a true income specialist, by the way, there are very few like myself that I have seen, and I wish there were more. And I don't know why more advisors haven't gotten on that bandwagon. But most advisors overall don't offer enough income producing vehicles, so their clients are not getting enough income. And that way, how do you get the money out of your portfolio? You have to sell shares. And that doesn't really work because that'll help you to run out of money really fast. My clients know that income and growth are completely different. My clients actually understand the difference. They like growth, don't mistake me, but they also want to be able to spend their income without having to sell shares. Their ownership of those companies that they own, they don't want to have to sell them. This is the Retire-tastic Show, and I'm Joanne Regan, your host, where my goal is to help you have a fantastic retirement. And today we're talking about dealing with unknowns. So what are those unknowns? Inflation is a big one. Where are interest rates going? Interest rates should be concerning to people in retirement because they're trying to earn income on their investments. And right now, there is no such thing as interest on investments. It is so low, especially in the last 5 or 8 years. Remember, if you go back to the early 2000s, interest rates were around 5%, and a 5-year CD was around that. You could have gotten a fixed annuity at 6 or 7%, which is basically a savings account with an insurance company. And a lot of reasons why people pick an annuity over a CD is even if it's tied up for 5 years, they don't have to pay taxes on the income that they don't need. And quite frankly, interest rates are what the feds like to tinker with, especially short-term rates. If interest rates go up, guess what sector is affected? Growth. That's your Apple, Amazon, etc. Growth stocks take a hit when interest rates go up. If you go back to the end of 2018, interest rates went up, and guess what went down in value? You got it. And when they went down, whoa, watch out. Since they have a lot to do with how the market sometimes moves, it also affected the other sectors of the market. Food for thought. So if interest rates go up, exactly what's going to happen with growth-like stocks? They're going to go down. So the reason why I like dividend-paying stocks is because I can play the middle of the road and get my dividends regardless of what happens with the market. If there's an upside, then I'm going to get the upside, especially if I have an analyst that tells me what's going on. It's not a trap. I'm getting the company that is truly poised to go up. And I do have to say the word possibly because nobody knows what growth is going to do. Growth, capital appreciation, we know it fluctuates. But what I don't want to change in my client's portfolio is the income. Most investors need to understand that there's a big difference between growth and income. I get this a lot, especially when I'm dealing with people that are pre-retirees. They're not in retirement yet. They'll say, my portfolio since the 80s or 90s has done nothing but grow, grow, grow. And you know what? They're right. But when I get a little analytical with them, I tell them, tell me a little bit about where you are at in contributing to your 401k. How much you're contributing right now? And they may say they're contributing the max, like $25,000. So all of that is great. But unfortunately, when you become retired, you're no longer putting $25,000 in, you're taking $25,000 out. And now you're really going to have to pay attention to how you get your returns. And I really like to separate fact from fiction. You have to throw away averages, and you have to throw away a lot of the other things that we use to factor. And we have to compare and figure out, how are we going to make this work if the market takes a huge correction of 20 or 30%, and especially if you're selling shares to get your income out versus if you're taking out just your dividends and interest to live on. What a huge difference that's going to make to you in your retirement. And I can tell you that if you're not doing it that way and you're in retirement and you're worried about growth or the market risk, you need to give me a call and let me show you how we can change that for you. So once again, let me offer you that free report, The Universe of Non-Stock Market Alternatives. Again, The Universe of Non-Stock Market Alternatives. If you'll give me a call at 1-800-FSG-7890, I'll get that out to you by email or mail. And then you can see how investing for income is going to help you in your retirement and keep you from being worried about what happens if the market should correct. So you're listening to the Retire-tastic Show. I'm your host, Joanne Regan, and I'll be right back.
This is the Retire-tastic Show with Joanne Regan, powered by the Retirement Income Store and brought to you by Financial Security Group of Arizona. Have you missed any of today's program? No problem. You can hear all of the Retire-tastic Show online anytime, 24/7 at yourfsg.com. That's yourfsg.com. Welcome back to the Retire-tastic Show with Joanne Regan, powered by the Retirement Income Store and brought to you by Financial Security Group of Arizona.
I get a lot of calls from my little radio show here. Some people, instead of wanting the free reports or books or whatever, they just want to set up an appointment to talk with me for 15 or 30 minutes. I have a listening ear, and I try to figure out where they're coming from. I have to understand that first and foremost so I can think of a way to strategically help these folks. Or should I part ways and tell them to keep doing what they're doing? Sometimes I run across people that I'm unsure if I'm going to be able to work with or not, maybe for various reasons. I think it's extremely important to know that there's a common gradient between me as an advisor and them, because it's a friendship too, not just about being advisor. So welcome back to the Retire-tastic Show, and I'm Joanne Regan, where my goal is to help you have a fantastic retirement. So when you're interviewing an advisor to get you through the next 20 or 30 years of your retirement, there's a lot to consider. You know, you want to make sure you're working with a fiduciary because they're held to a higher standard. If you're talking to somebody that may work for an insurance company, guess what they're trying to sell? They're just going to be like a car lot. If it's a Ford dealership, they're going to be selling new cars. So if you're working with a fiduciary, they're going to be offering you not only the market and our income generating strategies that we do here at Financial Security Group, but they're also going to be offering you stock market alternatives. So back to working with good folks like you, I need to determine what the market was doing when potential clients first teamed with their current advisor. That way I can help them to understand that so far, so good. And it doesn't mean you're prepared for the downside, that's for sure. And if you ask someone that has been retired for only about 10 years, the last 10 years, the stock market has been up. So you should expect that person should give good kudos about wherever their advice came from. But the majority of people that are getting advice today, and I know this by looking at various portfolios, are still using mutual funds or ETFs that get them through retirement. What that means is if a person has $1 million with that type of advisor and they're wanting to pull out $40,000 a year in income or whatever, then just know, what if they're only earning $10,000 in interest and dividends? What does that mean? They're having to sell off $30,000 worth of principal. Since the markets are going up, They're growing principal back, even though they have less ownership of the companies they surrendered, but it doesn't matter because their monies have gone up. But then what happens when the market goes down and you're still needing that same $40,000 and you're only earning $10,000 in interest and dividends? Now you still need to sell off $30,000 of principal, but now what's happening? You are selling it out of stock that has gone down or mutual funds that have gone down in value. And now you're selling off $30,000 in principal, and all of a sudden you're using up your money instead of growing it back because the market went down, and sometimes it takes a while for it to get back up. That's the reason why you want to work with someone to help plan for those unknowns. To be able to plan for those, you have to be able to minimize the knowns and the unknowns. The knowns are, if I'm spending principal on behalf of our clients, well, that's a problem because I know that when markets go in reverse and they go down, that the client has less ownership, less income. Then in the future, they're going to have a problem going through retirement, and they're dwindling down their principal slowly but surely, which is not a great inflation hedge. Another unknown is we don't know what the rising cost of healthcare is going to be. I'll tell you an unknown. I turn off the TV. I get tired of hearing the news. It's not going to help me or help me have positive thinking, so I just stay away from listening to the news. I think it's one of the problems that people have today. They listen too much to the news, to things that more than likely are not going to happen. For me, I just want to feel better about myself and how I'm going to get through retirement and enjoy my retirement. There was a time when I was growing up that I can remember being told, enjoy it while you can. When you're 18 and older, you're going to have to take on responsibility and things that change, right? That's so true. But at the same time, we still need to enjoy things. We need to enjoy our life. There's nothing wrong with keeping up with some of the news, but we may listen to it too much. I think it's causing people to freeze and not do anything because they think the world is going to come to an end. Who knows? I'm going to tell you right now, I want to be prudent. I want to do what I think is in our client's best interest and my own best interest with my own money. This is the Retire-tastic program. I'm Joanne Regan, your host. I have people call into the radio show and ask questions, and there's this particular gentleman that I want to talk about. They had some great goals, him and his wife, and a lot of times we try to do things on our own. I get it, and I think we should have some insight and learn how money works, because quite frankly, you're the one who cares the most about your retirement. Anyway, I had this particular prospect call in, and they were currently living on almost $200,000 a year. And they said they had a 401k with around $430,000. And I thought, well, I hope they have a huge pension because this is going to be interesting trying to redo their income to get $200,000 a year from a $430,000 pension. They want the same, if not better, lifestyle in retirement. And I'm not sure how that's going to work out, but let's see what we came up with. These are the things he was thinking about prior to retiring. He was still a few years away from retirement. He was like 60-ish, and that means he could do an in-service rollover with his 401k more than likely. Most employers do allow that. And there's a reason why you want to do this early versus postponing till after you retire, but I'm not going to go in that today. But maybe you could listen to some of our archived radio shows on our website, yourfsg.com, if you want to listen to me discussing in-service rollovers. Or give my office a call and we can certainly go over that on the phone. So this guy, I performed a quick top-down analysis while I was on the phone with him. He had $188,000 in income, but we're going to round it up to $200,000. And I asked him what he was contributing to his 401k and his wife's 401k and the combined FICA, which goes away on their salary income. When I did all of that, I noticed they had a huge need of more money. They're living off of about $115,000 a year, and his goal was to take the $430,000 from his 401k and pay off his mortgage, which essentially would save him $45,000 a year. So using the analysis, I will tell you that this absolutely wasn't going to work. One of the things that the gentleman didn't think about was the $430,000 that he wanted to take was how much taxes he was going to have to pay on that right off the bat. And then even if he paid off his mortgage, he still needed $115,000 a year. So if you took his Social Security incomes between him and his wife, only income was going to be about $80,000 pre-tax. So if you subtract 80 from the 115, that's a $35,000 difference in income. And that's $3,000 a month less than what he was living on now. And I didn't really have the heart to tell the guy that he's going to need to continue to work if he wanted to retirement, unless he absolutely was sold on paying his house off to have a lesser lifestyle. Because after I reduced the mortgage savings, he was still living on less. And I can tell you right now, he doesn't have any inflation hedge. People need to realize that Social Security really doesn't increase that much throughout retirement. You don't really get a hedge with income from that. And I've been doing this for over 30 years, and I seldom see a true cash flow increase in people's bank accounts when we review those with our clients. With that being said, income is going to need to increase regardless of whether you're debt-free or not. I'm not saying he can't do it, but he's going to be living at home and doing less. And I was able to do everything I could to try to find a positive way to tell him that. And he said, no. I said, we could build a plan around a lesser lifestyle, or I could just go ahead and get rid of the debt. And I said, well, I really think that you have some issues here. And the good news is he decided to make some changes. And I'm glad, because he had a very unrealistic goal and unrealistic expectation. The good news is he's still contributing and still growing his money, but not to the tune of being able to pay off his house. He is going to have to grow his money significantly to be able to do that. By the way, he didn't have enough anyway, because when you cash in that 401k, you have to pay with after-tax dollars, and it just wasn't going to work no matter what we did. Now, I know from doing this radio show for quite some time that you're going to have some questions that need answering. So I want to get a commission report in your hand. It's called the Income Generation Report. And that's for anybody who is in the income generation. Well, if you're within 5 years of retirement, you're in the income generation. And this report talks about the real need for income in retirement, not manufactured income from spending down your portfolio month after month, year after year. That's a recipe for disaster. So I want to get that commission report in your hand. So call me at 1-800-FSG-7890, and I'll get that out to you. So again, you're listening to the Retire-tastic Show, and I'm Joanne Regan, and we've been talking about dealing with unknowns. And don't you just hate that there are so many unknowns out there? Inflation going up, and all the other things that are happening in our economy that we really don't know how we're going to be able to deal with at this particular point in time. I just really want to just point out that it's crucial to understand the significant difference between growth and income. Many people think that they're synonymous, and they are as different as apple and oranges. You want to get educated on how they differ. And I deal with people that want to retire and stay retired. Most people work all their lives to save to replace their employment income and deal with inflation and the unknowns and interest rates. Many want to enjoy their money and have their freedom without any kind of financial stress or worry. How can you do that? I have to be honest with you. You're going to have to plan. And you're going to have to plan to make sure that you understand that what you're doing is going to help you meet your retirement goals. So before we end today's show, I just want to let you know I am available to talk to you and go over your personal situation. We can chat and see if I'm a good fit for your financial plan. Give me a call at 1-800-FSG-7890 and let's chat. Let's talk about what your financial plan is, and let's see if I can help you. So you're listening to the Retire-tastic Show, and I hope you've learned a lot today. Please tell a friend about the program. We'll be back next week. Be safe out there, and thank you so much for listening.
That's all the time we have for today. To speak with Joanne off the air, call 800-FSG-7890. And for more information about our program, visit yourfsg.com. The Retire-tastic Show with Joanne Regan airs Saturday afternoons at 1 and Sunday mornings at 8:30. To speak with Joanne off the air, call 800-FSG-7890. That's 800-FSG-7890. Or visit us online at yourfsg.com.
Investment advisory services offered by FSG Financial Services, Inc., a registered investment advisory firm in the states of Arizona, Nevada, and California. Sound Income Strategies, LLC, an SEC-registered investment advisory firm, is a sub-advisor of FSG Financial Services, Inc. FSG Financial Services, Inc. and Sound Income Strategies, LLC are not associated entities. FSG is a franchisee of the Retirement Income Store. The Retirement Income Store and Sound Income Strategies, LLC are associated entities.